was May the 6th, 2010. The financial markets were fairly quiet. Suddenly, the Dow Jones Index began to move downward. First slowly, but from a level of 10,500 the Dow suddenly plunged 1,100 points. Stock traders were seeing things on their computer screens they had never seen before. Then another thing happens that no one understands. Almost automatically, the index finds its way up again. A half hour after the steep decline started, the Dow is back at the same level it was before the crash began. They call it the flash crash, and it happened in half an hour. But what on earth had happened? Stock traders are seeing a crater on their computer screens. Some put the blame on a single stock trader who must have gotten greasy fingers from eating a hamburger. He must have tripped over a key on his keyboard and by mistake punched a few zeros too many. But that appeared not to be the case. President Obama ordered an investigation by the SEC, the US watchdog for the financial markets. After 5 months, it reported its conclusions. It appeared that the flash crash had been caused by one big order, one big sell order, commissioned by investment fund Waddell & Reed of Kansas. But what the newspapers didn't mention was that this order was only the trigger for the crash. It was not responsible for it. Responsible were thousands of computer algorithms that engaged in so-called high-frequency trading. High-frequency trading is a new form of stock market trading where a computer program takes positions for extremely short periods of time. Extremely short in this context means a fraction of a second, microseconds. The success of these algorithms, that is the question whether they make a profit or not, has nothing to do with outside circumstances in the economy or the business world. Their profitability depends purely on the speed at which they work. The speed is such that no one can explain exactly why they behave as they do. Stock markets have always been unpredictable. But now, computer trading can lead to price movements that are not only unpredictable, but even in hindsight unexplainable, even to experts. What if the Dow Jones had not stopped descending at a loss of 1,000 points, but would have dropped a further 5,000 points? What if it hadn't just happened on that day at May 6th, but also on every day since then? Experts maintain that circuit breakers are the answer. Circuit breakers can hold stock trading for a while to calm the markets down. But circuit breakers can also cause computer algorithms to draw the conclusion that demand has dried up. And this worsens the chances of markets blowing up. In fact, this is exactly what happened on May the 6th. The central problem is that man has no control over his machines anymore. The speed at which stock market algorithms operate is such that even experts have no chance anymore to find out what exactly happened. In future, stock market trading will be even more unpredictable than now. With the advent of learning programs, even the builders of the software will be at a loss why a program traded as it did. In 2010, one sell order that was put in at the wrong moment caused the disappearance of $700 billion on the stock market. And in future, an unlucky convolution of circumstances could lead just as well to economic chaos. It's a problem we should solve before it gets a chance to destroy our society.